All right, let's dive into Albany International's second quarter earnings. This is one of those classic situations in the market that's just fascinating. On one hand, you have the headline numbers, which looked pretty decent. But on the other, you have the market's reaction, which told a completely different and frankly a much, much harsher story. Let's break it down. So if you just glanced at the top line, you'd think, hey, not bad. Albany International pulled in revenue of over $311 million. That was a solid beat over what Wall Street was expecting. And a beat is a beat, right? Usually that's a good thing. Well, not so fast. Because this is what happened the very next day. The market delivered an absolutely brutal verdict. The stock didn't just dip, it cratered, plunging almost 24% in a single session. A move like that after a revenue beat? Well, that just sends investors scrambling for answers. So that really is the central mystery we're unpacking here. How does a company beat on revenue and get punished so severely for it? What on earth did the market see that completely overshadowed that top-line number? Well, the answer, as it so often does, wasn't on the surface. You had to look behind the headline numbers. The real story was hiding deep in the company's margins. And here's where it all starts to make sense. Yeah, the revenue beat, but look at the adjusted earnings per share. Just 57 cents. That wasn't just a miss, that was a massive miss. And on top of that, adjusted EBITDA, that key measure of core profitability, took a big hit compared to last year. This is where the whole story just turns sour. And if you dig one level deeper, you find problems everywhere. Both of their main divisions had serious issues. The legacy machine clothing business got hit with a bunch of operational headaches, equipment breaking down, a new facility ramping up way too slowly. But the real disaster was in the high-tech engineered composites segment. They got slammed by costly overruns, especially on the big CH-53K military helicopter program, all because of something called EAC charges. Okay, so let's quickly define this term, because it's the villain of the story. EAC, or Estimate at Completion. Just think of it like the total budget for a huge long-term project. When a company takes a negative EAC charge, it's basically them admitting, whoops, this whole CH-53K contract is going to be way more expensive and way less profitable than we thought. And the killer is, accounting rules make them book those future losses right now, which just crushes your current earnings. Now, despite this absolutely disastrous quarter, management didn't hide. They came out swinging on the conference call, arguing these were all just temporary hiccups and laying out their case for a really strong recovery. The CEO, Gunnar Clement, was perfectly clear. He just said it plainly. We're confident in our recovery. It was a really bold stance to take. He was basically asking investors to completely ignore the ugly Q2 numbers and just trust the plan for the second half of the year is going to work. And to prove they meant it, they reaffirmed their full-year guidance. They didn't touch it. They're still promising to hit these numbers. But look at that EPS target. Getting there now is going to require an absolutely heroic performance in the back half of the year to make up for that Q2 crater. Their recovery plan is basically a four-part juggling act. 1, fix all those operational problems in machine clothing. 2, get that troubled CH-53K program under control. 3, get cost savings from a recent acquisition. And 4, ride the wave of the commercial aerospace recovery. I mean, that is a really tall order. There's almost no room for error. So this brings us right to the heart of it for any analyst or investor looking at this stock. This has become a credibility test. It's not just about the numbers anymore. It's about whether you can actually trust management's optimistic turnaround story or if that 24% stock drop is the more accurate forecast. Really, it all boils down to two completely warring narratives. You've got the bull case, which is management's view that says, hey, Q2 is a fluke, these problems are temporary, and the recovery is totally achievable. Then you've got the bear case, what the market is clearly screaming, that says these problems run deep, that CH-53K program is a money pit, and the guidance is just a pipe dream. But there's a new wild card in the mix. The company just announced a new CFO. Willard Station is starting September 1st. And here's the kicker. He spent 16 years at Boeing. Think about that. Getting a guy with that much experience from one of your biggest customers could be absolutely critical for restoring financial discipline and maybe, just maybe, some investor confidence. So, the path forward is actually pretty clear. The new CFO starts in a few weeks. Then, all eyes are going to be on the Q3 earnings report in late October. That is the first real test. We'll see if the recovery plan is actually working. And then the final verdict on their 2025 promises will come with Q4 earnings in January. So, with all that said, what's our take? Where do we land on this? Based on all the evidence, here's our prediction and our official rating for Albany International heading into this crucial next quarter. Our prediction is this. We think Q3 will show some signs of life. It'll be a modest improvement from the Q2 disaster, but, and this is a big but, we believe the core problem, fixing the profitability on that CH-53K program, is going to be a much slower, tougher grind than management is currently letting on. Therefore, our rating on the stock is market perform. Look, the stock has already been hammered, so a lot of the bad news is already baked into the price. But without clear, hard proof of an operational turnaround, especially in that composites business, we just don't see a lot of upside in the short term. Right now, the risk and the potential feel pretty balanced. So really, the question for you as an investor is pretty clear. Do you bet on management's promise, or do you listen to the market's fear? As always, this analysis is for informational purposes only. This is not financial advice. Please be sure to do your own research before making any investment decisions.